So, Mike Muller, let's kick off with you. And perhaps with the year ahead, we take some context from the year behind, hence the title of this session. Why were oil markets, oil prices relatively immune as they continue to be to what in previous eras would have major geopolitical events like in the Middle East in particular, turbulence even in the shipping lanes of the Red Sea, and yet oil markets, oil prices in 23 and continuing into 24 are relatively immune. Your thoughts on that thesis, if indeed you believe it, or two, why does it exist?
So taking oil, the real black swan event, if you look at any price chart, was COVID, right? Standout in terms of price impact. If you take the wider energy markets and natural gas and power in particular, then of course the Russia-Ukraine crisis and other factors have caused turmoil there. But since your question was about oil, indeed, we've started the year in a $75, $79 per barrel type range for Brent. And the fundamental view remains one of a relatively balanced market. Whilst inventories are historically at the lower end of the range, very much a product of OPEC plus price policy, there is also a very balanced view in terms of how demand is ebbing. We still have year-on-year demand growth. So whilst in the Western Hemisphere, there's very much a mindset of peak oil demand being behind us, Asia is still racing ahead in terms of consumption and strata of population joining the consuming middle classes and all that. But yeah, the reason you're not seeing prices reflecting black swan events in oil is these are not black swan events. They're very much newsworthy. They're very important, and some of them carry great dangers. But things like the joint military action to prevent missiles from Yemen hitting merchant fleet ships coming through the Bab el-Mandeb have not served to materially disrupt shipping routes and have not served to materially disrupt oil prices.
Looking at that, sort of looking towards 24, and the reason I wanted to sort of get the context of the relative immunity of the oil markets from shocks, in the sense that a well-supplied, idle supply, these aren't black swans, but ultimately a market that is major war still going on in Europe, etc., that it sort of gives us a prism in which to look forward into 24. We started 23 with a market that was quite tight, very well, managed by OPEC plus. And as the year went on, that sort of grip loosened. As we go into 24, through that prism, what do you see big events to watch out for, whether they be market trends, whether they be otherwise, that you think will determine the direction of travel for the markets and prices?
If you just go back to the fundamentals of supply and demand, and starting with crude oil, with a couple of short-term exceptions, there's more oil available from more sources than has been the case for a very long time. Venezuelan oil is back. The General License 44 is in place. Of course, Venezuela has seen chronic underinvestment, and therefore it's not producing at what it used to do in the Venezuelan glory days, but nonetheless, that oil is coming to market. There's still a question mark hanging over Kurdish evacuation, certainly to the Mediterranean, but some of that oil is finding its way to domestic refining and into southern exports. With the exception of a short-term blip in Libya and the El Sharara field, which is significant, we have oil coming from everywhere, and sanctioned sources of crude, namely Iran and Russia, are finding their way to market in decent quantities also still. So the entire thesis of underinvestment coming out of COVID on long lead deep water projects by the oil majors, which caused a lot of concern that there would be a consequent lack of non-OPEC production. The numbers for 2023 are roughly 1 million barrels a day from the Americas alone, with the USA, Brazil, Canada, and Guyana in that order, each of them at least 250,000 barrels a day year-on-year supply growth, making up more than half of oil demand growth under anyone's demand growth measure. And the consulting shops and research companies still differ a little bit on the 2023 oil consumption. But looking forward to 2024, will that continue? There is still a consensus of analysts that the US is continue to grow crude supply from right now about 13.3 to this time next year, maybe 13.6 seems to be the midpoint consensus, maybe 13.5. So that's not the same pace of growth from the US. But it looks like the bringing on stream and the maintenance of production from the pre-salt Brazilian structures, the next phase from Guyana, will all add production, which challenges OPEC. And for OPEC to have some wriggle room to allow for the historic non-compliance, there's never 100% compliance, requires global demand growth to outpace that non-OPEC supply I talked about. And I was just talking about the Americas, of course. Now, on the demand side, you keep coming back to places like China and India. Those are the two major economies that are going to account for growth in 2024. And we see some slowing in China, although the official GDP growth number is still 4.5 and India 6 point something. So those two are going to be the stalwarts of demand, but very different. It's largely petrochemical feedstocks in demand for China, LPG and naphtha, which is the growth accounted for in 2024. And in India, it's all diesel. So the fundamentals for 24 look similar to 2023. And of course, the big focus is on the spare capacity that Christoph's been talking about and how OPEC Plus and Russia keep their various partners or factions in line.
Just to pick up on that point, the idea that we should acknowledge certain things, we should acknowledge that the Paris climate will not be met and adjust strategies accordingly. I put it to you that we start a year in which we should acknowledge that China has reached some element of as the Eurasia Group has called it, peak China, and that the China is now is not coming back like out of COVID. Oh, everybody's still waiting for Godot, and that peak China, the manufacturing industrial build China is now over, and we're in a different place and adjust accordingly. Your thoughts of that theory, Eurasia Group? I'm echoing it a bit. Peak China, will that sort of penny will drop in 24?
I'm not so sure, Sean. There's been a lot of discussion about the third consecutive month of negative PMI numbers out of China below the 50 mark. But you have to put that alongside the demand numbers for energy. Power demand is up, and even demand for commodities that's heavily influenced by the construction sector, which is the weakest part of the economy, namely cement, is up. So is shorter-term consumption of transportation fuels. So whilst you have an economy that everyone says is in the doldrums, the official growth number is still around the 4.5–5% number. But the short-term nowcasting, as some of us call it, is showing a pretty resilient set of demand numbers coming from something that is not construction and is maybe not even manufacturing, given the negative PMIs. But China is on the move. We just had the government forecast the likely travel for the Chinese New Year period, which of course falls in a slightly different period every year, but they're forecasting nearly 10% more flights and therefore jet demand than in the highest previous, which is the pre-COVID Chinese New Year in 2019. So, I mean, just as a microscopic snapshot, I was on holiday in the Alps, and the proprietors of hotels and shops and restaurants were telling me they've never seen this many mainland Chinese tourists. Of course, those are the upper classes that make it all the way to Switzerland. But if you have something like 35 million Chinese joining the spending, saving middle classes, even if only a fraction of them jump on planes for the first time in their life, I think we're going to see jet demand close that pre-COVID gap, which is the last piece of the demand barrel that's missing. And as for peak oil, yes, in the West, yes, in OECD, we're down still more than 1 million barrels a day on pre-COVID demand in OECD, but non-OECD, the rest of the world, is up 3.7 million barrels a day compared to pre-COVID. And the number that we're kicking around here, which is the consensus of all the analysts, is that 24 oil demand growth versus 23 is still going to look like something like 1.6, 1.7, 1.8 million barrels a day, including NGLs, of course. And that's still a very steep trajectory to get from
how much of that would you, how much of that 24 number, we saw obviously last year, China was a big part of the 23 demand growth number. I think of the 2.5, maybe it was more than half. What percentage would you see China demand growth in 24 of that 1.6?
Well, more than a third. More than a third easily.
Mike, your thoughts on the same thing? I mean, more about, you know, what do you still look to OPEC Plus to give a clear direction of travel for the oil markets in 24? Are they the force they were a year ago, the world's largest informal oil exporting group?
No, as I hinted before, I think 24 looks like it's going to replay a lot of 2023. the call on OPEC Plus and on Saudi in particular, who have taken on the mantle of swing balancer, will remain well below their capacity. And in order for supply demand to remain in balance and this sort of slight backward curve to the crude markets, which favors OPEC's policies, they will continue to have to keep capacity off the market. And that capacity, as Christoph said, is growing as people continue to invest in having the upstream capacity. And I guess the biggest excess capacity versus quota is where you're sitting, Sean, in the Emirates. Yeah.
And when you look at the sort of aspiration OPEC cutting, and you put it up against what you said, repeat mirror of 23, where we had the Americas growing, is that balanced going into 24 through 24? You signaled your thoughts that the Americas couldn't continue on the same trend line of growth, and so OPEC may not have to cut it. I mean, where do those two things meet in a 24 market with a 1.6 demand growth? Does OPEC Plus need to cut more to balance the market? Mike, your thoughts on that?
Yes, if non-OPEC supply is going up and taking a fair percentage of the overall demand growth, then that leaves OPEC having to cope with the balance. I mean, I think it's fair to say the demand growth we've been talking about, 1.7, 1.8 million barrels a day year on year, is substantial. It's a healthy kick to the upside in terms of demand. Non-OPEC won't close all of that. Therefore, there's space for OPEC Plus to take some extra share of production, but it's not material. It still requires them to keep their policies pretty much in line with what we've seen for the last couple of years.
Mike, last word to you in terms of that wider lens as we look out to 24 horizon.
Yeah, I mean, coming back to China, and COP24, they are still growing. They've overtaken Japan some time back as the world's biggest car exporter. BYD is outflanking Tesla as the biggest EV manufacturer. Their emissions credentials, there's a lot of policy, but they're behind on their rollout of their emissions scheme. In general, I think China is stealing market share on the petrochemicals front, which is the big new growth item. Huge capacity installed on the petrochemical side from neighboring countries. And as such, China is still growing in those base industries. On the supply side, I mean, those operators of those Brazilian and Guyanese assets, so Exxon, Shell, doing a great job at bringing supply to market. The Permian Basin sector is vibrant on the M&A front, so there's plenty of faith and backing there. Some consolidation, but many asset transactions going through there, showing that there's interest not just from the private sector, but also from funds in backing low-cost production in the right places. And I guess we haven't mentioned yet, but there are elections not just everywhere in the world, but also in the USA, which could, of course, lead to rather more interesting geopolitical policies should that go back to the prior president. But watch the news, I guess, because there's a big question mark over the outcome, isn't there?